Welcome to the MUFG Global Markets Podcast. I'm John Cook. I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, February 7th, 2022. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you. So we've seen some pretty impressive price action across global fixed income markets so far in 2022. I think I've heard colleagues talk about how it feels like we've already experienced an entire year in a month, and I think that's a good way to think about it. But the JGB market is no exception. 10-year JGBs, as example, have sold off sharply, taking yields to their highest levels since early 2016. I guess the question is, what's been driving price action, and what sort of market catalyst should investors be watching out for in February?
JGB rate rose to 0.2% recently. The hawkish policy stances among major central banks and an interdependency between the yen, JGB, and dollar bond markets are highlighted. Over the near term, geopolitical risks in East Asia are expected to die down for a bit during the Beijing Winter Olympics on February 4th to 20th. Japanese companies and investors' yen repatriation flows from overseas assets will pick up after the Chinese Lunar New Year week. In Japan, Prime Minister Fumio Kishida will probably call on Japanese companies even more for wage hikes based on his new capitalism during the spring wage talks. Through the end of the fiscal year, Japanese companies are expected to implement their capex spending, carry out overseas investing projects in the pipeline, and rearrange their asset portfolios while eyeing wage hikes. Dollar-yen basis has been widening of late as Japanese companies hedge their risk of rising dollar asset funding costs. Japanese government will have to show achievements, including from the measures to prevent the spread of the COVID-19 virus out of the summer upper house elections. This time, the Japanese government more actively encouraged Japanese companies to increase wages. So we feel these will likely have a negative impact on our investing behavior of Japanese companies and investors.
That's interesting. I feel like, you always hear of, pressure by the Japanese government on boosting wages, and it doesn't ever seem to really do so much. It sounds like it might be a little bit different this time. The context is obviously very different. There's, inflation's all over the place, less so in Japan, but still certainly more so than we've seen in a long time. So moving on, Sekido-san, you mentioned in a recent report that the Bank of Japan would allow rates to rise in January. I'm just kind of curious for you to take our listeners through the underlying supply and demand mechanisms at work here.
The MoF absorbed money by 12 trillion yen, so the Japanese government deposit of the BoJ rose to 28 trillion yen in January, primarily due to the net JGB issuances and tax revenues. Then the BoJ supplied the funds by 6 trillion yen. In December, Japan's monetary base increased by 9 trillion yen. And in January, the monetary base decreased by 6 trillion yen. So JGB 10-year yield rose to 0.2%. In January, the top three asset instruments the BoJ used to supply funds to the market were through purchases of first, JGBs, and a second, TDBs, and a third, commercial papers. The BoJ allowed Japan's monetary base to shrink and the JGB yield to rise.
Okay, so tying things together, you have hawkish central banks globally, despite the BoJ being pretty dovish, kind of behind the scenes doing things a little bit more hawkishly. So that was also supportive of price action. In that same report, you noted that fiscal factors would have a big impact into fiscal year end. Could you please discuss that as well as the interplay between that and cross-currency basis?
In February and March, ahead of the fiscal year end, the MoF will increase 3 months TDB issuances. The MOF has indicated it expects abundant government funds to finance accelerated spending of the fiscal year 21 budget. The MOF projects net general fiscal spending to top 10 trillion yen, mainly from 8.8 trillion yen of other COVID-related spending in February. The MOF appears to be planning to boost issuances of 3 months TDBs and getting ready for implementing and increasing spending as a fiscal year end. 3 months dying forward widened primarily because of the U.S.-Japan yield gap. Yen basis has also been widening, and both Japanese companies and investors in particular have been funding dollar positions with yen basis and have strong demand for dollar-yen hedging. At the same time, in dollar terms, Japanese TDBs remain more attractive than US T-bills. We think that Japanese investors could put their abundant dollar into US short-term securities as the US Treasury yield curve follows highly expected US rate hikes. Japanese companies are the well source for yen basis widening this month.
Got it. So could see a little bit of demand for the front end of the Treasury curve as that cheapens up, and then presumably some hedging there, and then on top of that you have just this underlying widening pressure on the basis from Japanese companies. That's really interesting. So why don't we tie things all together here, and wrap up with your outlook across yen rate, spot dollar yen, and yen basis.
US dollar weakening has prevailed. Over the near term, the US CPI will be closely watched. If market speculation grows about rising inflation on the back of high resource prices, then dollar will start to rally. However, OPEC Plus has indicated that it will limit increased oil output. Dollar yen downside could be limited. We expect a neutral bias for dollar yen with trading in a 2 yen range, now lower to 113.50 to 115.50. The yen swap rate curve has risen and steepened, but speculation of the US Fed rate hikes may have been priced in too much. Interest and dividends from overseas assets could be converted to yen in February, and the yen rates could pause in their rise. Aside from a 10-year JGBI auction on February 8th, only TDB auctions are planned for this week. We expect yen rates to return to a neutral bias again from an upward bias. The yen basis curve has widened, particularly on the long end. MOF weekly data shows that the Japanese investors net bought 42 billion yen of overseas securities on January 23rd to 29th, while overseas investors continue to unload Japanese securities by a net 226 billion yen. Japanese investors bought a net 690 billion yen of overseas stocks and investment fund holdings, while unloading a net 555 billion yen of medium to long-term bonds. U.S. stocks collected after the January FOMC meeting, and Japanese investors appear to have rebalanced their holdings from falling stocks to falling bonds. Japanese investors bought more falling short-term securities by a gross 876 billion yen, while unloading a net 91 billion yen. This suggests that Japanese investors adjusted their foreign currency positions with short-term securities. Overseas investors unloaded a net 120 billion yen of Japanese stocks and investment fund holdings and a net 229 billion yen of short-term bonds, but net bought medium to long-term bonds by 561 billion yen. overseas investors have been showing a fairly strong preference for JGB rate risk. Over the near term, outward investing flows are likely to pick up after the Chinese Lunar New Year among both Japanese and other Asian investors. On the other hand, Japanese companies' yen repatriation flows could be sizable as they repatriate funds from overseas assets. We expect yen basis to return to a neutral bias from a tightening bias.
Yeah, so many cross currents. It's absolutely mind-boggling. But neutral across spot dollar yen rate and JPY basis. Although you did mention more medium term, you have a widening view there.
Yes.
So I think that sounds like a pretty stable market. I suspect most people like me wouldn't mind to see that this week. So let's see if that plays out. But great stuff as always, Sekido-san. Thanks for joining us.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.